Howdy out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, October 17th, 2022. Just starting with our economic release spotlight. So, just want to highlight a couple data points that we got out of the U.S. economy on Friday. So clearly, the big juggernaut was the 5 to 10-year forward inflation expectations index out of the University of Michigan consumer sentiment survey. That thing ticked up 20 basis points to 2.9%. That was that 20 basis point rise was actually the fastest increase we've seen since May of 2021. And so clearly what we saw priced in the markets on Friday was obviously, more hawkishness from the perspective of the near term Fed funds FOMC meeting. So you got a 75 basis point rate hike is now the modal outcome for the December 14th meeting. And now we got the terminal Fed funds rate peaking at 5% on February 1st. Elsewhere in the data, we also had manufacturing and trade inventories data coming out of the U.S. economy again for the month of August. That data slowed to 18.2% year over year and to 11.2% on a 3-month annualized basis. So slowing, but still growing at an extremely rapid pace in terms of inventories. And so a lot of investors are looking at this sort of growth rate of inventories, the growth rate, and saying, hey, we're going to have this sort of deflationary unwind of excess inventories over the medium term. And we would push back against that. When we look at our some of the analysis that we did in October 22 macro scouting report shows that inventories are only about 6.4% of U.S. Private non-financial corporations' balance sheets in terms of their total assets. That number was right around 5.6% heading into COVID. So not really much change there. So we're not sure why we would see a big reaction from an inventory destocking perspective in terms of write downs, et cetera, et cetera. It's more likely that corporations are going to take advantage of this, what has become a historically rare time to push through price increases. It's been a long time that corporations felt the confidence and the ability to push through some of these price increases. So we think the resistance to severe discounting and a big deflationary wave of discounting is going to remain quite staunch. Just shifting gears from the risk management side of things, looking at my Longbow dashboard here, just going down global macro, dollar still bullish, getting towards the upper boundary of the range there, but not quite. Gold, that's still bearish, getting towards the lower boundary of the range there. We're right around 1631 for gold is the lower boundary there. You got 10-year treasury yield, that's bullish. Where we at? Because to me, this is one of the big upside risks for asset markets this week. We talked about that in our Around the Horn and lead up morning note last week. S&P 500, that is still bearish in the middle of the range there. VIX bullish in the middle of the range. NASDAQ, and it's bearish still, getting closer to the lower boundary of the range there. Where's the lower boundary there in NASDAQ? It's around 10,500 for those of you who are short tech stocks. Russ 2000, that is bearish right around the middle of the range there. Bitcoin, bearish in the middle of the range. Ethereum, same deal here. Shanghai Composite, that is bearish, overbought here, coming out of this, or nearing overbought, coming out of not the FOMC, the Chinese Communist Party. They're communist. Blanking on the name for this, so ignore the name. So one thing that was reiterated over the weekend was Xi was reiterating or tripling or quadrupling down on zero COVID. Outlining Taiwan reunification as one of their stated objectives. So no real material changes or deviations from what we thought would happen, but clearly not good from the perspective of the Chinese economy and its influence over the global economy in terms of reaffirming zero COVID. This is an overbought signal there. So if you've been, if you've been short China, or you want to be short China, you're starting to get to a level that would make sense to put on that trade. And new crude oil, that's still bearish in the middle of the range. Ag, that's neutral here. Again, towards the lower boundary of the range here is the Bloomberg Agriculture Index. Got a little bit more downside there. And then lastly, industrial metals, that is bearish in the middle of the range. And then for those of you who like to trade options or tactically risk manage, we try to leave you every day with one or at least one tactical trading idea that's being generated by my dashboard, which is I got 300 ETFs, so they're about all representing individual factor exposures across global macro. They're sorted by odds in terms of upside downside. So nothing overbought here in terms of shorting or booking gains on the long side, but certainly get some oversold signals on Simplify's QQD. This is the NASDAQ with downside exposure or so downside convexity. That's their NASDAQ ETF there. A lot of things are looking oversold. You got palladium here. For those of you who want to whip the bones on maybe throw some bones on palladium into OPEX. You got Argentina, Chile, Brazil, Peru, Latin America's broadly oversold here. I know a lot of folks are focusing on Brazil heading into the election. This might be a decent spot to buy the election. Obviously, there's a lot of open the envelope risk as it relates to Jair Bolsonaro and some of the claims he's made in terms of not going to accept the elections. Are we going to get a Jan 6 version down there in Brazil? Who knows? But certainly, if you're a strategic investor, this is the kind of market kind of exposure that we would expect to outperform over the next several years. So this is maybe a decent spot if you're dollar cost averaging into places like Brazil, Peru, Chile, Mexico, et cetera. That'd be a decent spot there. But otherwise, certainly not. This is not the time to be loading up on high beta emerging market risk assets. Really, just for the strategic investors out there. And then lastly, what else out here? Retail and home construction, two pockets of the U.S. consumer story are both oversold as well. So definitely not chase these, be booking gains on the short side, or certainly don't be chasing them on the short side heading in OPEX this week. We talked about the risk of, the upside risk into and potentially through OPEX in our lead off morning notes over the last couple of days, and then our around the horn. So if you want exactly how to position for that, definitely go check out that research. We'll just only drop a couple of hints here, but anyway, home construction is very much oversold here. So definitely don't be chasing home builders on the short side here. That's a very nasty setup. This is how you get squeezed in a bear market. So anyway, wrapping up our macro minute for Monday, October 17th, 2022. Best of luck out there, everyone. Have a wonderful week. Cheers.